Good morning, everyone. Thank you so much for joining us today. I don't think I can identify a more timely moment for an insurance outlook. With so much going on, not just in the industry, but in the world as a whole. So today's webinar is going to cover a very wide range of subjects. It's designed to give you a full sense of the whole landscape, what you and most likely your colleagues are wrestling with around your organizations. We've asked the topic presenters to keep their observations brief, and that'll give you a genuinely broad insight into the issues that you and your colleagues are dealing with. In each case, we could easily talk for 30 minutes on any topic, but we won't. Instead, what we'll do is we'll focus on the broad strokes, and we'll provide you with links or follow-up links to the greater detail. So where you want to hear more, you know where to turn to next. And of course, as usual, you can reach out to me, you can reach out to the speakers, you can reach out to your usual BDO contact if you want to have a more detailed conversation around these issues and your business. With that, I'm Graham Handy. I'm the Head of Insurance Advisory at BDO. There's some brief housekeeping to cover off. Just to remind you, the webinar is going to be recorded. We'll circulate the slides and the recording in a few days' time, along with useful links. So if you get a chance to click on links in the chat where you're interested, that's great. But if you miss it, don't worry, that'll come out in the recording and the follow-up in a few days' time. You can submit questions to the panel throughout the session using the Q&A function. We'll either deal with it in the Q&A or we'll respond offline as appropriate. I'm joined today by a bunch of folks. I'll introduce those as we go. As usual, massive thanks to Rima Stevenson, who works so hard to make these events come off cleanly. Firstly, let's turn to the actuarial, the risk management and the capital arena. I'm going to introduce Jamie Bentley. He's a director in our actuarial practice. Jamie, whilst you come on screen, there's been a huge amount of activity in actuarial and risk management over the last year as part of IFRS 17, the changes to the UK solvency. We've got general reporting challenges. At the same time, there's been a huge amount to think about in the pricing and underwriting arena. So how are the finance, the actuarial community handling all of these pressures? What's on their minds? What's going to be consuming their time in the in 2025?
Thanks, Graham, for the introduction, and hi, everyone. Thank you for joining today's webinar. Now, in the actuarial space and just the insurance arena more generally, there's been quite a lot of change going on at the moment, as Graham just alluded to. So some as regulation or law, some being that insurers are just continually trying to innovate themselves to enhance their own information, processes or controls. I think with that in mind, there's sort of three topics where we've seen quite a flurry of market activity recently that I think I'll just quickly touch upon hitting the actuarial space, which are the Solvency II or Solvency UK changes, Ogden rate changes, and then financial transformation or actuarial modernisation. So if I firstly start with Solvency UK, and as many of you will be aware, the UK is moving away from Solvency II following Brexit. And the PRA is establishing its own rules and requirements. And many of these are going live for the very first time this upcoming December year end. And, you know, the finalization of such rules are going to be due in a week or two from now. But simultaneously, EIOPA are currently holding consultations on the Solvency II reforms for EU insurers, meaning we are now at the point where EU and UK solvency regulations are diverging. Now, we don't have time to go into all the detail of the changes that are on the cards there. But one thing I think has been very apparent is that insurers have been a bit caught out in the messaging, which has largely been interpreted in the market as a reduced burden for Solvency UK. But this is not always the case, at least initially, to get over the first year's reporting hurdle. So the quantitative reporting templates that are reported to the PRA are changing. And even some third country branches are having to complete additional forms and documentation which they never had to before. And you know, with the finalization of these templates only released in the next week or two, many of these oh, okay, there's not many changes expected from the near final versions released earlier in the year. However, that does still create quite a big execution risk of delivery, given there's only 3 or 4 months until then the regulatory reporting deadlines to, change all the processes and data collection, anything that might be needed as the changes to reporting happen. And some of the forms are quite data intensive themselves. So we've had quite a lot of companies reach out for support after sort of, getting lost in the initial messaging, thinking it's going to be a reduced burden, so they don't need to worry. But actually, that's not been the case all the time. And yeah, not to scare everyone on the call. After all, Halloween was last week, so hopefully onto a slightly more positive topic for insurer financial statements, which is the Ogden rate change, or the personal injury discount rate, as it is officially known. So this rate decides the damages awarded to people with long-term bodily injuries, and it's recently increased markedly in Scotland and Northern Ireland up to a positive rate of 0.5%. With the rate for England and Wales still yet to be determined, but will be within the next 2 months. But given the direction of travel in the other home nations, a positive increase and therefore increased discount rate is expected, which will reduce the liabilities on insurer balance sheets and increase profits, although the exact amount is uncertain, with some insurers taking a preemptive guess in the region of 0.5 to 1%. And whilst there may be some sort of minor operational challenges in updating liability valuations, the positive discount rate is likely good news on the whole. And then another likelihood is, for now, is that just a single discount rate will apply across the whole UK, given what's happened in Scotland and Northern Ireland. It was consulted upon back in, I think, 2023, whether a dual or multiple rate system would be beneficial, given the fact that investment returns vary over the short, medium, and long-term durations. And whilst this certainly could be implemented in future, given the complexity and need for a transition period and what has happened already in Scotland and Northern Ireland, it's very unlikely to be implemented in 2025. And then one last note to be aware of relating to Ogden is that as is the case, whenever the discount rate changes, there's potentially associated claimant behavior changes. So lump sum awards become less appealing when discount rates are high, which could increase the prevalence of PPOs, periodic payment orders, which are quite similar to annuity payments. So it means that longevity risk could become a bit more prevalent to insurer balance sheets. So now, while the first 2 topics were a bit more prescribed in nature, Solvency UK or 2, and Ogden, where we don't have the control over the setting directly, financial or actuarial modernization is one where the company is mostly in the driving seat, although often it may not feel like that on the ground because you've got many different stakeholders to consider. But what we are seeing is many companies are starting to undertake these transformation projects, to increase management information or analytics capabilities, or make use of enhanced processing capabilities to save time or resource, create greater unity between departments, as well as have an enhanced control environment, which is very topical given the corporate governance code. And it obviously represents a great opportunity to make use of new technologies to create the finance or the actuarial team of the future. It can link up with Solvency UK reporting or IFRS 17, as well as the reserving and pricing transformation projects, which have been underway in the market for several years now. And I think with the potential to cover most of the operations of an insurer's business, careful planning, focusing on the areas which need the most modernization first, understanding the different synergies between businesses and the business departments, and obviously testing, making use of dry runs are very much paramount to the success of the transformation projects. But it's definitely a hive of activity in the market at the moment, with all companies at very different stages in their transformation journeys. So that's sort of the 3 topics that spring to mind right now, and I think that's all we've got time for in the actuarial space at the moment, unfortunately. So I'll hand back to you, Graham.
Yeah, thanks, Jamie. So it sounds like sort of a lot of change coming in that part of the business. Some of it very mandatory, some of it semi-voluntary, but a lot of change. And Jamie, I think it's fair to say we're planning to host a series of roundtables: CFO, CRO, Chief Actuary. So one of the things we'll post in the follow-up materials is a link to expressions of interest.
Yeah, and hopefully we'll also have a few
roundtables.
articles coming out as well, hopefully to expand on some of these topics as well.
Yeah. Okay. Thank you, Jamie. Let's, I mean, moving on from that quite naturally, I think, let's go perhaps to Nicola Ball next. Nicola is our insurance lead for all things governance, reg, compliance, conduct, and she's very well known to many of you with her regular appearances on the consumer duty topic. So Nicola, I suppose if you were to summarise everything that you're seeing right now across the PRA, the FCA, the Lloyd's agenda, what would you say the prevailing regulatory theme is, and what's keeping you up at night?
So yeah, I think, as you say, Graham, it's been a very busy time in the insurance space. I think the regulators have been focused on ensuring firms know what's expected of them, as well as looking to embed good standards across the sector. And I guess what that means in practice is we're seeing quite a high volume of comms and publications from the regulators, as well as more exploratory type work. So things like Section 166 reviews from both the FCA and PRA, thematic reviews. And I guess in the insurance sector, what we've seen is a focus on areas such as risk management arrangements, oversight of outsourced providers, conduct and customer outcomes, and governance arrangements. And I was just going to pick up on what we're seeing from an FCA perspective with a focus on 3 key areas that I was going to discuss today. So those being the FCA's themes from the recent regulatory initiatives grid, a bit of a spotlight on product governance and fair value assessments. I think that's an area of sort of challenge with a sort of consumer duty lens, as well as sort of signposting 2 upcoming FCA market studies. So I think on the FCA initiatives grid, I wanted to highlight that we saw the delayed regulatory initiative grid published in mid-October this year. And this is an interim update, so it's a little bit different to normal. It's focused on a shorter period, so between October this year and going into March 2025, and we'll go back into a normal state of play following elections, etc. But in terms of some of the areas that's highlighting from the FCA lens, that talks about customers with vulnerable characteristics. So we're expecting to see the output from the FCA's review in this space in Q1 next year, which will explore how firms are meeting the FCA's vulnerable customer guidance from 2021 and the expectations in that space. Consumer duty, so this continues to be a focus with various initiatives relating to the consumer duty, including the opportunity potentially to simplify some of the requirements. Pure protection market studies, so I'll cover that in a little bit, and then also operational resilience, so including expectations of firms when incidents occur. Maybe moving on to the product governance and fair value assessment side. So there was a couple of really key consumer duty publications in the insurance space over the summer. One was the multi-firm review of outcomes monitoring under consumer duty. And the second was this thematic that I mentioned here around product oversight and governance. And the findings from both of those reviews indicate that the FCA expects more to be done in these areas right across the industry. I think they want the bar to raise. And they really want firms to consider how they're positioned against some of the output of those reviews and the findings that they published. And maybe just to bring to life some of the areas highlighted in the thematic on the product oversight and governance piece, I was going to mention a few of the challenges referenced in relation to fair value assessment. So those being, for example, the use of benchmarking in fair value assessments. So firms need to make sure that they aren't selective in who they're comparing with. So, aim to give a completed view as possible. Don't just select competitor products which make you look good. And over-reliance on benchmarking. So don't conclude on fair value on benchmarking alone, particularly if there's limited providers in the market, as that could, reduce the level of insight, I guess. The other area, customer cohort analysis within fair value assessments, and also actually the sort of broader monitoring that you do. Firms really need to be proactively identifying different customer groups within their assessments and monitoring their outcomes to ensure that all groups are receiving good outcomes and fair value, and really focusing on not sort of masking outliers by looking at averages. So, for example, cohorts may include vulnerable customers, customers using different channels, or customers who may purchase a product, for example, using premium finance. And then I think the other sort of area, which again is sort of a sort of common challenge highlighted, was around, you know, making sure you've really sort of set out your analysis and how you're taking action off the back of your fair value assessments, the monitoring that you're doing. So not only ensuring that you're providing insight and the rationale and justification for, you know, how total price paid by the customer is consistent with providing fair value within your assessments, but also where you are identifying potential concerns, ensuring that action is considered and taken. I think that's what the regulators really want to see, that sort of play through from start to end. And I think last area, I just wanted to signpost that proposed terms of reference have been issued for 2 market studies in the past couple of months. So one was the pure protection insurance, and the other is premium finance. So these market studies will really assess the potential indicators and characteristics that can lead to poor competition and consumer harm. They take a while to sort of play through, so it can take about 18 months from publication of the draft terms of reference to issuance of a final report. And the next steps that we'd typically see would include finalisation of the terms of reference, issuance of a call for input, and then, you know, following the field work and engagement in the market, an interim and then a final report. And remedies off the back of market studies, they can vary, and, you know, they can include rule changes and interventions. And you might recall that, you know, we saw, you know, banning of price walking following the GI pricing practices market study. But anyway, the terms of reference for both of those are not yet finalised, so we're a while off seeing the output. But to note that is in play at the moment.
But we also, I guess, running through all of this, we can see a sort of a strong sort of consumer advocate type mentality, and I guess that's against the backdrop of, you know, people's wallets being tighter, you know, needing to protect the, you know, the hardworking families, etc. So this sort of this focus on the retail product proposition isn't going away. Do you agree?
That's absolutely right. I think, yeah, that the sort of backdrop of cost of living crisis means, you know, that focus on value is really important. The focus on, you know, those customers with vulnerable characteristics, you know, whether that be financial difficulties or other sort of circumstantial aspects, that's a real focus. So I think, you know, both of those kind of play through in terms of some of the areas being under the spotlight at the moment. Yeah. And also within those market studies. So it's not just one lens, it's around competition, it's around, you know, treatment of customers, for example, value in the distribution chain. So it's trying to cover, yeah, a range of angles.
Yeah, thank you, Nicola. I've got a strong feeling we'll be coming back to some of these in the question session, but that's a very useful summary. Again, for our listeners, so if you want to get into more detail on any of that, aside from just reaching out to Nicola and her team, the most natural way to do that is to link through to our regular regulatory update bulletins, and we'll be posting a link to that in the chat recently for those of you who don't already receive that. I suppose the other big legislative change we've seen in, you know, literally the last week has been the UK tax budget. So, I mean, Thomas Toe, Thomas runs our insurance industry tax group, and he's been picking apart all of the moving parts on that budget and all of the other big tax questions that we face as an industry. So, I mean, Thomas, what's your you know, what would you say what should be keeping our listeners' tax colleagues most busy at the present time?
Thanks, Graham. Yes, the budget of the Labour government took place last week, as we all know, and as you've I'm sure read, it was designed to raise £40 billion of tax revenue, and it was a lot of changes, which I do not have time to cover here, unfortunately, but I will be covering some of the key talking points that I know are happening within the insurance industry. But actually, where I will start is what wasn't in the budget. And I know the entire market has breathed a collective sigh of relief, you know, to hear that there was no mention to the increase to the rate of IPT. So that was a bit of relief. I know all the trade bodies were rallying very hard, you know, against it. So I think that's good news for the market. There's also actually no resurrection of that UK captive regime that was touted by the Tory government. There was meant to be a consultation on this regime anyway coming in for the UK, but no resurrection of that. And I know that comes again, as a disappointment to particularly the London market. So moving on to the things actually that were put forward by Rachel Reeves. You'll see a lovely picture of her there on my slide. So a few big talking points in industry. The biggest one, the increase to employers' national insurance contributions. That was increased by 1.2%, 15%, national minimum wage up. Now, we all know that the insurance industry is a massive employer of people. So that will add a significant cost to a lot of insurance businesses. Talking to in some cases, I talk to clients, millions of pounds. And I guess the question is, how is this extra cost going to be absorbed by the businesses? Will it be absorbed by the business themselves, hitting bottom line? Will it be through reduced pay increases? Will it be through reduced promotions, reduced new hires? I think in reality it will be a mix of all those things. So something to certainly think about for all businesses, because as I keep saying, this is a very significant increase in costs. The second thing I'll talk about is to investment strategy, I suppose, investments. Again, these are big sort of news headlines anyway. Inherited pensions, they are to fall within the inheritance tax regime. Capital gains tax rates going up, stamp duty rates going up. So all these things will actually change the way that people invest. Now, again, for the insurance industry, we've seen actually pretty significant outflows or withdrawals anyway by people from their pensions. And also, these sorts of things, making people think twice about, do they invest in pensions? Do they invest in other assets? Do they invest in stamp duty? So again, this will have large implications for insurers who do sell investment products, for example. So lots to think about there in terms of business and sales of products. The final thing I'll quickly talk about is carried interest. Now, this affects private equity, for example. And I know a lot of the insurance industry, are invested into by private equity. So with this move to increase the tax rate on carried interest, so really affects fund managers. They'll be paying more tax on these sorts of investments anyway, and which are linked to performance. So again, you have to question, what does that mean for the PE, and how will the fund managers react? Because they're very sensitive to remuneration, as you can probably imagine, and how well they're rewarded. So I think this is having a big impact, and certainly talking to a lot of friends, clients, and so on, people I know about this in that particular space. It's a big concern, and particularly when we're having there's also plans in 2026 for this particular regime to be aligned to the income tax regime, because of course at the moment it's aligned to the lower capital gains tax regime, which is a lower tax rate, but moves to aligned to income tax regime means a fairly significant increase actually in tax in the hands of the fund managers. So really lots to think about. It's a quick rattle through some of the big talking points, some of the things that I'm talking a lot to my clients about, but there's a lot more changes which I've not covered here, as you can see. But if you want to have a much more comprehensive and complete list and oversight of things that are happening in the budget, please do go to our website and talk to any of your main contacts at BDO.
Thank you, Thomas. Thank you. And again, if you could perhaps sort of post a link to that more broad budget review that the firm's done UK wide, then I mean that'll be of interest to anyone who's an investor in other industries, right? Which we as an insurance sector do end up being exposed to the entire UK market as well as the global one in the end. So it might be of people's interest to look at the full broad budget review as well. But I think what's interesting is the impact on investors into our industry, and we'll hear a little bit more from Kyri later about the general sort of transaction environment, the impact on the natural proposition that our insurance clients offer to their customers. There's a lot of change stirred up by this, isn't there? And that's even without the things like IPT that we thought might be coming. So thank you for Thomas for that. Okay, so let's perhaps now move across to financial crime. By the way, before I introduce Megan, and please do keep your questions flowing. We've got some really good ones coming through. There's still time to register more, and as you post those to the Q&A link at the bottom of the page, then we'll ensure we address those in the wash up at the end. So yes, to financial crime. I mean, one of the big themes we've seen focus on for many years, for good reason, is the area of financial crime across financial services. So that's fraud, and that's sanctions and money laundering, etc. So we are joined today by Megan Quilter. She's a senior manager in our economic crime team. She specialises in this for insurance. Megan, once you cut through all the theoretical risks and consequences around these topics, what would you say ought to be the sort of the practical mindset for insurance boards, insurance management teams? What's occupying the money laundering officers' mind at the moment in a typical insurer?
Well, so the main area I wanted to focus on today, which I'm sure will be fresh in everybody's minds, is the new failure to prevent fraud offence, which has come under play under the Economic Crime Corporate Transparency Act. This legislation is going to place a significant responsibility on firms who meet the criteria, that being kind of 2 out of 3 stats, which would be over 250 staff members, over 18 million in assets, or over 36 million in turnover. So this new legislation essentially is putting the ownership of fraud on the firms, and if you have failed to prevent a form of fraud, and the firm or an associated person benefits as a result, you could be liable. However, there is a way around that, and that is ensuring that you have reasonable defence and reasonable measures in place to prevent such frauds. So the government has yet to release exactly what approach they expect firms to be taking, but what we're seeing at the moment is people really trying to get on the front foot and ensuring that they kind of have a strong and solid framework in place to be prepared for this legislation. One of the key distinctions to make here, though, is the difference between external and internal fraud. So internal fraud is where you and the firm would be a victim of the fraud, whereas external fraud is where you stand to benefit from the fraud, and that can be either the firm as a whole or any associated persons within the firm, so employees, contractors, etc. So it's quite common practice at the minute that people have largely only focused on where internal frauds could take place. So what we're seeing is the fraud risk assessments are focused majority on internal frauds, and there's been that lack of conversation, that lack of lens on how firms stand to benefit from fraud and what that would look like. So what we're saying a key starting point would be, at this stage where we haven't got the guidance yet, is to ensure that all fraud risk assessments are including external frauds, thinking about what that looks like for you as a firm, how those frauds might crystallise, and what mitigating controls you would need to have in place to prevent those frauds from taking place. So that would be the key starting point. Following identifying what those frauds would look like for you as a firm, it's making sure that you've documented them, documented the risks, documented what the mitigating controls are, and then have a process in place where you regularly revisit the external frauds that may face the firm, and then also have processes in place to assess the mitigating controls, assess the effectiveness of those controls, and that will really put you in a strong place to demonstrate what your reasonable processes are to use as a defence should a fraud take place. So that is a key area. There's obviously a big change in the industry, and one that we really
recommend. Long as, so I guess you don't want to be a management team or a board who haven't just taken some reasonable steps. If you can't demonstrate reasonable steps, then there's a real exposure. That's the
real exposure, and there's liability there, which, you know, as long as they can prove that an intent was there, then that liability will lie with the firm, and there will be repercussions as a result.
Okay.
So that is kind of, like I say, the big change, the big one that I think needs to be at the forefront of everyone's minds in terms of preparedness for that guidance coming out. An easy one to prepare for, like I say, taking those processes, extending your current fraud risk processes to cover consideration of external frauds, not just internal frauds, and just making sure that you've got that defence in place will be really helpful to all insurance firms. There's obviously a couple of other, well, main financial crime risks. How am I doing for time, Graham?
Yeah, I mean, so I guess the headline for that's the big legislative change that's coming. I suppose the other question for general sort of fraud, economic crime would be, what would you say the sort of 3 or 4 key areas are that a listener to this call ought to expect their fraud teams to be thinking about at the moment?
So if we're thinking about failure to prevent, there's a number of really key risks that I think will face the industry. There's your standard big ones like bribery and corruption, which I imagine that everybody does have a number of controls in place already. But there'll be other things to think about, such as collusion with third parties, depending on the nature of the insurance work, whether that's healthcare providers, repair shops, etc. Collusion with brokers or agents to kind of push certain products to customers against their best interests. Misleading marketing practices is a really key one. So kind of like exaggerating policy benefits and coverage limits, etc. Misreporting in general, kind of your financial statements, any ESG commitments and achievements is a really common one we're seeing a lot of at the moment. Making sure that you've got practices in place to ensure that what you're putting out to the public, you can back up with data and evidence, etc. And then kind of misrepresentation of the progress and outcomes of any legal disputes are really common external frauds.
Okay. And these it strikes me, these are sort of almost like business as usual topics, but the bad actors are constantly changing their approaches. So, what would you say is emerging in terms of, different natures of fraud that our listeners should be aware of?
There's obviously with the developing technologies that are coming out, we see at the minute there's kind of a common fraud will come into play, and the people will kind of get to grips with the fact that that's something that we're aware of, and then they'll change their tactics. So with technology, we've kind of got deep fake technology coming out, cryptocurrency fraud, those are all really common ones that kind of need that constant level of scrutiny within the organization to make sure that you're kind of aware of things that are emerging and making sure that you're then updating your defences against those on a regular basis.
And you're seeing examples of that technology being applied to the insurance sector?
Yeah, absolutely.
Yeah. Okay. So to me, it feels like that's the big takeaway. The legislative arena is constantly changing and putting more onus on us, the people on this call. Meanwhile, the bad actors are embracing ever more complicated means of attacking us. Yeah.
Especially where we've got kind of, identity theft and application fraud is a really common one for insurance sector. That then added layer of technology is making it even harder for firms to have the necessary controls in place to be able to detect those. So it's an ever-evolving threat that needs that constant attention and kind of constant evaluation of your fraud risk processes and controls.
Okay, well, thanks, Megan. I mean, again, that's an awful lot to cover in a few minutes, but we have an open call out to folks for an expression of interest in an insurance fraud, economic crime roundtable. We've been running that regularly for the banks, the asset managers, and it feels like it might be a topic that might be of interest to some of you listening in today. So again, express your interest if you'd like to sit around a table and discuss that for our industry. We've got 2 other key topic areas to cover. Both, I think, are of interest in the here and now, with things moving on at seemingly a fast daily pace. So can I first of all turn to Sasha Molodtsov. Sasha is a partner, and she's the leader of our ESG business for financial services. And can I ask you, Sasha, you're talking daily with many of our market participants, but also the policymakers, the wider commentators. What should be on the radar of our listeners in relation to ESG, and what should they expect their businesses to be getting ready for 2025?
Thanks, Graham, and good morning to you all. As you say, Graham, there is never a dull moment in the world of ESG and sustainability. And what I really wanted to do today is flag 3 things that have just happened really in the last couple of weeks, and then give you an update based on some Chatham House rules, broad discussions that we've had, as you say, with policymakers and leaders in government initiatives as well. So the first thing I wanted to cover there is the Transition Finance Market Review that was just launched on the 17th of October, really focusing the minds there on what the recommendations for insurance market is. Nicola mentioned the interim regulatory grid. I really want to lean in more on the S and G, focusing on non-financial misconduct and bringing in the links there specifically around the revised culture principle for those in the Lloyd's market. And then finally, just touching on the UK endorsement board, where we are at with the ISSB adoption in the UK. But what I do want to do first is just invite you and colleagues of yours back at base, if you are leaders of ESG, if you do have those sustainability responsibilities, I want to invite you to join us for a roundtable that will happen later this month as well. But look, let me start with the Transition Finance Market Review. Now, this was only launched on the 17th of October. And I guess the context here is firms, nations are really working on their transition plans, meeting those decarbonisation targets that, of course, everyone has set, those net zero ambitions. But I guess for boards and for execs and product designers, insurance firms, the question of how we get there, what do we need, and the real kind of crunch is around finance and how we're going to finance those transitional activities. And so in that context, the previous government commissioned what is called a kind of a systematic review, very aptly chaired by those that know her, Vanessa Harvard-Williams. We had the pleasure of hosting one of our climate risk events just a couple of weeks ago. And the review is really looking at what does the UK financial services ecosystem need to do to become a leading hub for finance, but also the provider of professional services. Now, it's a 133-page report. Let me orientate you to the chapter where the insurance market is really looking at a number of recommendations, and that's section 3.6, and I'll put in a link following this commentary. Now, the specific role of the UK insurance market is called out to really help with, I guess, de-risking transition, right, in terms of your products, and really supporting that financing across the life cycle of projects. So the specific insurance solutions that were called out in this report across the life cycle include examples like credit and political risk, construction, all risk insurance, same with supply chain interruption, operational all risk insurance, technology performance, and then finally, at the end of that life cycle, decommissioning liability insurance. But I guess the report goes a bit further. It's not just the insurance products and solutions. It calls for collaboration from this sector. It calls for leaders of the reinsurance market, the insurance market, to work with HMT, City of London, and the Department of Business and Trade to create international outreach programs, positioning this domestic market as kind of that hub for global transition finance. So really recommend you read this report, focusing on chapter 3.6 to look at what role insurance is being expected to play in this field. Moving away from the E and very much on the social and governance aspects. As you know, Nicola said earlier, the FCA has been busy. And on the 25th of October, just 10 days or so ago, we saw the much anticipated release of the non-financial misconduct survey findings. Now, there has been a huge background, drivers, political drivers, industry drivers, regulatory drivers in the last 18 months, I would say, around non-financial misconduct, culture, and the broader space of diversity and inclusion. Specifically, the FCA and the PRA consultation papers last year, Treasury Select Committee's Sexism in the City, the Diversity Project's Safe Space, the Lloyd's Culture Principle Update, and the Workers' Protection Act, just again in October at the end, coming into play. And all of this, we've seen a huge focus from boards, focus on the second line and the third line in terms of what firms' arrangements are in place. But let me zoom in on what the insurance findings were for this FCA report. Now, this was a wholesale market report, and for insurance, there were 357 Lloyd's market intermediaries that provided data and 185 Lloyd's market insurers. Now, a lot of you in the room were involved, I imagine, and you had to provide 3 years worth of data around incidents of non-financial misconduct. Now, the headline is the incidents have gone up, right? For insurance from 2021 to 2023, incidents of non-financial misconduct went up and are rising and are continued to rise, which is really disappointing because obviously this market has done so much work in that cultural transformation to get, you know, as using Graham's words, kind of the bad actors out of the market. And I think we need to kind of read into this in a really positive way as well. And the FCA acknowledges that whilst the numbers are going up, and this is around things like sexual harassment, bullying, violence, intimidation, it could mean that actually we've got a really good, healthy culture indication that people feel safe to speak up, systems are working, and actually all the good work that's been done in the sector is resulting in that transparency and action to be taken. However, regardless of the way you want to see this cup half full or not, as it were, firms need to take action. And what the regulator is saying that there is an expectation of boards and management to take steps and review their culture, how they identify and manage risks, and address, obviously, non-financial misconduct ongoing. Now, this links to the Lloyd's market and the principles update. And of course, thinking about the MPNP coming up, the board attestations coming up, how firms are demonstrating zero tolerance, speak up culture, psychological safety, and really working with trade bodies to really develop those sector initiatives. So my message is the non-financial misconduct is going to continue to be the FCA's focus. We know that policy is coming out by the end of the year, specifically on that, followed by in the first quarter of next year, as Nicola said, kind of March indication from the grid that the FCA and the PRA policy statements on the remaining D&I proposals will be in play then. Now, finally, we also had a session with the UK Endorsement Board last month. And of course, there's a big kind of process to adopt the ISSB's Sustainability Disclosure Standards S1 and S2. So what I can tell you is we are on track. And what this means for you is next year, when the adoption takes place, the process is that it will go through a consultation process and then the FCA will bring it on board and be able to introduce standards for sustainability related requirements, but really starting only for the listed community. So for those of you in the listed space, look out for the listing rules there. So finally, it is my pleasure to invite you, as I said, we have a roundtable coming up on the 19th of November. Please, if you're in the ESG space, or pass this on to your colleagues, I'll pop a link in the chat. We'd love to hear from you. But that's kind of the hot trot through the land of the E, the S, and the G, Graham.
Thank you, Sasha. It's interesting as always. I mean, it's clear we've got to get the tone right, and we've got to own the right narrative as, you know, participants in the industry as a whole. It strikes me, it remains so difficult to keep track of all of the moving parts. And, you know, if you've got your handle on exactly what we need to do to comply with all of this change, then that's a very valuable part of addressing that, I think. So I'm interested in seeing what you discuss at your 19th of November event. Look forward to that, Sasha. Thank you.
Indeed, thank you.
And that takes us to Kyri. So Kyri is a senior manager director in our transactions space, the corporate finance world. He sees all of the moving parts on, you know, the deals that happen, the deals that ought to happen but don't, and why they don't happen. And, you know, every webinar we try and get a little bit of a sense of a roundup of the M&A environment for the insurers in the UK. So Kyri, can I ask what you're seeing this autumn? You know, what's the prevailing mood at the moment?
Yeah, thanks, Graham. Good morning, everyone. So I'll talk about current trends and also kind of take a kind of a more high-level view, look at what's happened over the last couple of years and how that sets us up and what we think is going to happen next year in terms of M&A deal activity. So whilst that loads, so in the UK and Europe, kind of the volume of insurance transactions has continued to increase in the past few years, despite challenging market conditions that you're probably all aware of. When the slide comes up, there'll be a graphic where you can see that there were 574 European insurance transactions announced last year, and the UK remains the hotspot for deal activity, with 232 of those transactions in the UK and Ireland, and that's a 31% increase from the prior year. So some of the key things coming out of that is 2/3 of these deals involve private equity, which we've touched on previously, and that remains the key driver of deal activity, and we expect that going forward as well, with the consolidation of intermediaries continuing. And approximately 90% of M&A activity by volume is in the intermediary and service provider space, which is where we as a team at BDO at NTS primarily focus. So I'll just give you a minute to take a look at those graphics. So you see on the middle left one, combined PE involvement from both direct acquisitions and also through the PE portfolio companies makes up about 90%, sorry, 2/3 of total activity. And that's consistent whether you look at Europe as a whole or just the UK, as well as obviously the involvement of PE and the conceded consolidation of the intermediate space is deal size. So whilst the scale of broker consolidation has continued, despite forecasts of the country, we've seen deal sizes declining. So part of the reason for that is with the current interest rates and over the last year or two, some buyers have been reluctant to undertake larger deals as they may be nervous of taking more debt at higher rates, and given the previous uncertainty around rising inflation, economic outlook, and especially for some of the larger acquirers, ratings gradings from taking on leverage. And additionally, probably more obviously, is many of the mid-market brokers have already been acquired. So we're now seeing the focus on the small end of the market. And another thing we're seeing is, and to be expected, is European deal activity is on the up. So the number of European transactions increased by a third last year to 342, which we'll come on to shortly. So despite years of consolidation in the UK and a perceived lack of targets, there are still plenty of indicators to suggest activity levels are going to continue into 2025 next year. So there's currently a focus, what we're seeing by acquirers, on core products and acquiring skills or product gaps, although there is still an appetite for higher margin specialist or niche lines and MGAs, although these come at a valuation premium. There's ongoing appetite, for scale platform broking for MGAs, and that's from insurance carriers, broking consolidators, strategic acquirers, and private equity, and for many reasons, including the specialised underwriting expertise that they provide, their product knowledge, geographical expertise, and the use of data and technology, as well as kind of the high EBITDA margins and recurring revenues that PE value so highly. And so whilst I touched on the impact of rising interest rates on M&A activity earlier, these, along with the fact that inflation has stabilised and expected to decline, is making borrowing to finance transactions more affordable, and again will drive deal activity. And probably most importantly, there's still plenty of private equity capital which has to be deployed. And with valuation,
do you think that, or do you think that you don't know the answer to this? I know speculation, of course, but do you think that's going to continue despite the budget changes, or do you think that might be a hiccup in that appetite?
It might. So I think it will continue, but potentially maybe not as quickly as we first expected. So with expectations of rates coming down to kind of 4% by the back end of next year, that may be delayed into the following year now. But I think there is still more certainty, at least. We knew some of our deals that we were trying to get over the line before the budget, and then we've been speaking to some of our clients who were delaying it, obviously, to the back end of the year, maybe next year, to see what was going to happen with the budget and tax changes. So we'll see what happens and how that impacts activity. But the ones that have been holding off from making acquisitions aren't necessarily going to hold off for too long.
Okay, and it's more about is the economic environment stable and understood? It's more about that than any particular budget change item. Yeah. Okay.
And yeah, so touching on the PE, so that activity will continue. Part of the slowdown from PE previously was around financing and the availability of it. But yeah, as I said, the expected decrease in interest rates, and also the use of private debt and equity funding rather than bank debt is helping to facilitate some of these PE-backed transactions. Some other drivers of activity are the increased regulatory burden. It's making life tougher for broking leaders, and many approaching retirement age. Quite a few are likely to be looking at an exit. And again, going back to kind of tax and also government impacts. So whilst rumoured increases of capital gains tax drove some activity in the lead up to the budget last week, elections and changes in governments and taxes in the UK, the US, and across Europe may have caused some companies to have deferred their investment decisions, which we expect to come back next year. And I touched earlier about the impact of the rise in the transactions across Europe. So there is plenty of outwards investment into Europe. The consolidation that we previously experienced in the UK is now in Germany and other European countries. And that's been driven by various things, so by regional European consolidators and established international platforms. But probably more of a recent trend that we're seeing is what were previously UK-focused consolidators and PE companies are now branching out to Europe. And I think SRG is one of recent announcements, I think a couple of weeks ago, announced going into Asia and Europe. And yeah, the opportunities in Europe in terms of the number of targets and more fragmented industry and the increased focus on expanding European footprints from international and previously domestic consolidators is expected to continue and drive activity next year. And finally, on valuations, we've seen they've fallen from the highs that we saw a couple of years ago, and that's partly due to economic outlook and uncertainty. Obviously, the higher interest rates and inflation were affecting willingness to borrow and finance transactions, which put a slight dampener on it. But also, there has been a reduction in deal sizes, and with larger deals, they typically attract higher multiples. So obviously, driving multiples down with the smaller deals. And also, the sellers are realizing that the pandemic era valuations have now passed, and they are accepting lower valuations. And we're also seeing some companies are facing challenges, whether that's cash flow difficulties, capacity constraints, having to work harder to win business, regulatory burdens, economic headwinds, and all these factors combined pushing against their businesses. They may decide now to sell now rather than waiting and sell now at what is a lower valuation compared to what they may be achieved down the line. But bearing all of that in mind, though, there are high multiples being paid, and that's typically with niche businesses, and we've seen some go in the high teens recently. And obviously, there is still money in the market, and where there are attractive assets, there is still high competition for those assets, and that again drives up valuations. So that's a very brief summary of the kind of insurance M&A outlook and what we expect for next year. But keep an eye on our website where we'll be posting some M&A insurance related articles soon.
Yeah, thank you, Kyri. I mean, that's kind of, I think that's I take that as overall encouraging. Actually, there seems to be a trend and reasons to be hopeful, particularly for anyone who actually really wants to see a better valuation on their assets. So that's good, and it is interesting to see how all the things we've discussed in this webinar are kind of coming together. In your space, so the tax changes, the focus on the customer, the proposition overhaul and reviews that the regulators are looking at, the operational elements. It kind of all seems to be coming together. So quite a nice way to wrap up the download part of this webinar. So thank you for that.
Thanks.
So with that, we've got a few more minutes left, and I want to address some of the questions that have been flowing through from the audience. So thank you for those. Perhaps the first one I'll go to was one that was directed towards the actuarial side. Let me just get that up in front of me. So, Jamie, you made a number of references to change, to transformation. It was the one bit of the list which actually was kind of perhaps that the timing was more in the control of our clients rather than imposed by a regulator. So what patterns are you seeing in terms of specific change, specific transformation? What's the emphasis? And then the second part of the question is what's proving to be most problematic for clients?
I guess it's quite different depending on the company, and I think that maybe if we were to pull some general trends out there, it would be companies maybe aren't necessarily putting the transformation at the full forefront. Business as usual gets in the way, and these sort of transformations are very time and resource intensive. So you're not actually making anything happen, taking it really slowly, and then maybe by the time you start to act, there's a new piece of software, new technology, and you're already behind. So I think it needs very careful planning and regular milestones, and thinking about flexibility as you're going in case you do need to potentially pivot. And then the other area I would say is, and I sort of alluded to this, is just the stakeholder agreement. Obviously, you've got many different operations in the business potentially joining up for the first time in a sort of really coordinated way. And I think it's very natural to think about what you want in your team, what's best for your team, and you're effectively just all digging your heels in and not actually getting
what
the change.
stakeholders actually want.
Yeah, and you basically need to sort of figure out a way to sort of compromise and see what are your non-negotiables and what you are prepared to just to make the change move forward. And I think that they're probably the two things that were sort of the main trends that we've seen.
Okay, and none of that's easy, right?
No.
I suppose the easy stuff's been done. It's hard. Yeah, interesting. And that runs across actuarial, but into risk, into finance. You know, there's a lot of investment needed, I sense, in a lot of companies to actually achieve what stakeholders want from those back office functions. Interesting. The other question that came through was an interesting one. I mean, Nicola, you mentioned skilled person reviews as part of your, regulatory sprint conversation. So, I mean, skilled persons reviews, painful, difficult. How what's driving them? What's the focus, and how can a company avoid one? Being blunt.
Yeah, good question. So I think, maybe just to sort of help position that, I think in terms of what's triggering some of those Section 166 reviews, so we're seeing those coming from both the FCA perspective as well as from the PRA. Sometimes that is triggered by a very firm specific issue where a firm may have notified the regulator about an issue, there may have been an incident, and on further investigation, the regulator has further concerns that they want to investigate. It may be off the back of some of the sector work. So I talked about some of those multi-firm reviews, thematics. If you're an outlier in terms of what you provide in terms of call for input and some of those conversations, that's also firms are sort of finding themselves under the spotlight if that's the case. And then there's other triggers. So whether that you might have had a firm visit from the regulator, there might have been a whistleblowing event, complaint. So all of that can be a trigger that sort of leads down a path that could ultimately end to a skilled person review, a Section 166 review. I guess, a more tricky question might be, how do you avoid them? So I think there's maybe a couple of avenues that, by doing so, you sort of hope to stay on the good side. So I think I kind of talked about some of those triggers being around if you're providing information to the regulator, that can sometimes lead to sort of further conversations and further spotlight. So I think if you're submitting documents to the regulator, really do prioritise the collation of those, review what you're sending. It sounds very basic, but, make sure you know what's going over to them. Spend time drafting, reviewing a cover letter that really, provides signposting, context, gives a feel of the journey you might be on as a firm. If you're having a visit from the regulator, prepare. Again, might seem simple, but and maybe have an orientation session to sort of, position yourselves in terms of where you are. Make sure anyone being interviewed understands the objective of the visit, knows what documentation's been sent, and has an opportunity to perhaps sort of test just that interview environment with mock interviews or walkthroughs, etc. The other areas where there are publications in the market, so we've seen quite a lot of good and bad practice, do take steps to benchmark where you are against those. So I think that provides a very good sort of step to demonstrating some tangible action you're taking. And then I think the final one is, if you have got areas of concern or you're seeing that other parts of the sector and market are getting under the scrutiny, think about doing health checks. So pre-Section 166 reviews, external reviews, internal audit, do your own sort of due diligence into those areas and investigations to sort of try to be on the front foot of those and redress any potential issues.
Okay, so it sounds like it's not possible to over prepare, to over communicate, essentially.
I think that's it.
Okay.
A fair shout.
Okay. Well, look, thank you, everyone. We're coming to the end. We're on the hour. I'm conscious we haven't had time to answer everyone's questions, but we've made a note of them and we'll follow up and close those off. And you can also tell, I hope, just how enthusiastic my colleagues are about their topics, and they'll be delighted to hear from you on any of the things you've heard today. As mentioned earlier, we're recording this webinar, so we'll send you a copy over the next few days. And finally, I just want to thank the team for presenting today and all of you for joining, participating, and I wish you a very good rest of the day. Thank you.